Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Amazon.
If you find our talks useful, please consider subscribe, like, and comment underneath. All right, let's just dive right in. It is February 12th, 2026, and we're taking a look at the market, and Amazon is trading right around $207.
Right, and it's down about 20% recently.
20%? I mean, honestly, it feels a little scary. The ground feels like it's shifting a bit.
It definitely feels volatile.
Yeah.
You know, a 20% haircut on a company of that size is enough to make anyone nervous.
Right. So the big question on everyone's mind, and definitely on my mind, is this a falling knife? Should we stay away?
Yeah.
Is the story over? Or is this one of those golden buying opportunities we're going to look back on and just kick ourselves for missing?
That is the million-dollar question, or in this case, the trillion-dollar question. And to answer it, I think we have to look past the scary red numbers on the screen and see who else is buying right now. Because while, you know, retail investors might be panicking a little, this so-called smart money is doing something very different.
Okay, let's unpack that. Who are we talking about? Who's brave enough to step in front of this thing?
Well, it's a big one. Bill Ackman.
Ackman. Really?
Pershing Square.
Wow. Okay, that is actually really surprising. I mean, he's usually pretty picky. He likes these simple businesses, right? Like Chipotle, Hilton, you know, things you can understand in 5 seconds. He doesn't typically go for these huge, complex tech giants.
Exactly. And that's why this is such a strong signal. Pershing Square has initiated a whole new stake in Amazon.
A new position.
And what's fascinating here is the context. It's not just an isolated Amazon bet. Ackman is also betting big on Meta.
Oh, interesting.
He's put about 10% of his capital there.
So he's loading up on big tech leaders that are down.
It looks like a cluster buy. It really signals this broader institutional conviction.
Right.
You have these massive tech leaders trading at a discount, and guys like Ackman, who are, you know, famous for value, are seeing this pullback as a major mispricing.
So they aren't scared of the dip.
No, they're using it. They see $1 selling for 80 cents.
That's fascinating because when a stock drops 20%, there's usually a good reason. But Ackman is basically looking at the market and saying, you're wrong.
Or at least you're too short-sighted. The market is worried about the next quarter. Ackman's looking at the next 3 to 5 years.
So what does he see that maybe the rest of us are missing? Why buy now?
Well, let's dig into the fundamentals because we just got the Q4 2025 numbers. And if you strip away all the noise, the business engine itself is just humming.
Okay, give us the highlights. What's going right?
Gross profit is up 16%. That's $91.5 billion.
$91 billion. Wow.
But even more important than that, the gross margins expanded. They're up 1.8%, and they just hit 50.8%.
Wait, hang on. 50% gross margins. For a retailer, that sounds impossible. Retail margins are supposed to be razor thin.
And that's the thing. They aren't just a retailer anymore. Not really.
Right.
That margin expansion is not coming from selling, you know, toothpaste and books. It's driven by AWS and the advertising business.
A high-margin cash machine.
Or cash printing machines, exactly. Selling cloud space is a lot more profitable than shipping a cardboard box.
Sure.
But here's the surprise. Even the quote-unquote boring North America retail side is performing like crazy.
How so?
Sales were up 10% to $127 billion, but operating income on the retail side, it rose to $25 billion.
$25 billion in operating income just from retail in North America.
Is from retail.
I remember just a few years ago, they were barely breaking even on that business. They were just burning cash to ship stuff. How did they turn that into a profit center?
It's that regionalization strategy we've talked about before. They've completely overhauled their logistics.
Right, breaking the country up into smaller hubs.
Precisely. So instead of a package going from California to New York, it's coming from a hub that's maybe 50 miles away from you.
And that saves a fortune in shipping costs.
A fortune. And you have to add in the robotics.
The robots.
Yeah.
Are they really making that big a difference?
A huge difference. They're rolling out new AWS AI-powered robotics in the fulfillment centers. And it's not just, you know, an arm moving a box.
It's more than that.
It's AI predicting where inventory needs to be before you even click buy. That efficiency is what drove that $25 billion number.
That's incredibly impressive. I feel like the retail business making serious money really changes the entire equation for the company.
It does. It provides a really stable floor. But let's be honest, AWS is still the crown jewel.
Right.
Operating income for AWS hit $12.5 billion in Q4 alone. And the growth there is actually accelerating.
Accelerating, that's the key word.
Yeah.
But, okay, we have to talk about it. The elephant in the room.
I have a feeling I know where this is going.
The spending. The spending is just, it's absolutely eye-watering.
You're talking about the capex.
The capital expenditure, yes.
Okay.
It is massive, and I think that's what has so many investors spooked.
It is definitely the sticker shock from the report. Let's just break down the scale. In 2025, Amazon's capex was $131 billion.
Which is already a number that's hard to comprehend.
Huge. But for 2026, the plan is a massive jump to $200 billion.
$200 billion.
Yeah.
In 1 year. That's the GDP of a country. How does that not just crush their cash flow?
Well, it does. That's the painful part.
Okay.
That spending absolutely crushed their free cash flow. It dropped from $38.2 billion all the way down to just $11.2 billion.
That is a massive drop. I mean, if you're an investor just looking at that FCF line, it looks like a total disaster.
On the surface, yes, it looks like the money is just evaporating. But you have to ask the critical question, where is that $200 billion going? It's not going into building more warehouses for socks. It is almost entirely going into AWS AI infrastructure and data centers.
So they are betting the farm on AI, pushing all their chips into the middle of the table.
They are building the infrastructure for the next decade of computing. And this is where it gets really interesting and why the smart money isn't panicking.
Okay, I'm listening. Find me the silver lining in a $200 billion bill.
It's the backlog. The AWS backlog grew by 40%.
40%. So wait, just to be clear, the backlog, the signed deals for cloud services they haven't even delivered yet, is growing faster than their current revenue.
Faster than their revenue growth. Exactly. And that is the key. It proves there is a demand pull forward.
Meaning what?
Meaning Amazon isn't building empty data centers and just hoping customers will show up.
Customers are already there, waiting.
They are lining up for capacity that Amazon doesn't even have yet. They're effectively sold out and are scrambling to build fast enough to meet the demand they already have locked in.
That completely changes the narrative on the spending.
It does. Bank of America put out a note on this. They called the capex a competitive necessity and the key driver for future stock returns.
Because if they don't spend it, they lose those customers to Microsoft or Google.
Precisely. This is the toll you have to pay to own the AI future.
It's an investment, not just a cost.
Right. And while everyone's fixated on that spending, there's another hidden giant inside the company that's just becoming a monster.
You mentioned advertising earlier.
Yes. The ad revenue grew 22% to $17.7 billion.
$17 billion in a single quarter. That's bigger than YouTube, isn't it?
It's getting right up there. It's absolutely massive. And the moat here is incredible.
Tell me about the moat, especially with all the competition from, Temu and Shein. Everyone's worried they're eating Amazon's lunch.
Well, Amazon has a defense that Temu just can't touch. Two, actually. First is logistics. You order something on Temu, you get it in, 2 weeks?
If you're lucky, yeah. On Amazon, I can get it this afternoon.
Speed is the killer app. That's the first moat. The second is Prime Video.
What does Prime Video have to do with it?
They just hit a huge milestone. 315 million ad-supported viewers.
315 million. That's a Super Bowl-sized audience every single day.
It is. And unlike a TV network, Amazon has the ultimate data advantage. They know what you search for. They know what you buy. Their ads are incredibly effective.
Right. So if I'm looking for running shoes on Amazon, I see an ad for them on Prime Video later. That's powerful.
It's unbelievably powerful. And we're seeing this play out globally. Look at Australia. Amazon is gaining market share there despite Temu and Shein's rise. It proves their infrastructure wins.
That's a really good point. You can't just download an app and replicate 1,000 warehouses overnight.
And there are other catalysts on the horizon, too. There's some speculation about ad partnerships with companies like Netflix or Spotify.
So Amazon could sell ads for them.
It's speculative, but it makes sense. Amazon has the tech and the data. It would be a powerful combination.
That would be huge. Okay, so we have smart money buying, strong fundamentals, and this massive demand-backed bet on AI.
Right.
But the stock is still down. The guidance for next quarter wasn't perfect, was it?
It wasn't, and that's part of the reason for the drop. For Q1 2026, they're expecting net sales between about $173 and $178 billion.
Which is what, 11 to 15% growth?
Yeah, which is still solid for a company this size.
Sure.
But the operating income guidance was a little bit below what the street wanted to see, 16.5 to 21.5 billion.
And why was that light?
Investments. They specifically called out something called Project Leo, which is costing them $1 billion right off the top.
Project Leo, what is that?
They're being very quiet about it. It's probably related to their satellite internet project, Kuiper, or maybe a new AI device, but it's $1 billion of profit that's vanishing into R&D.
Short-term pain for long-term gain. It's the Amazon story.
It's always the Amazon story, and analysts are looking right past it. Bank of America reiterated their buy rating with a $275 price target.
$275 from 207.
Yep. They're basically framing this as a setup for 40 to 65% upside from here.
That is significant.
And Zacks agrees. They rank Amazon as a strong growth stock for this month. The consensus is that this sell-off is just an overreaction to the big capex number.
Okay, so play devil's advocate. We've been pretty bullish here. What are the risks? What could actually go wrong?
The risks are very real. And the biggest one is that $200 billion bet.
The capex.
If that AI demand turns out to be a bubble, or if they can't execute, then that $200 billion spend becomes an albatross, an incredibly heavy burden on margins.
Owning a bunch of empty, expensive data centers, yeah, that's a bad business model.
It would be a disaster. There is real execution risk. And they can't take their eye off the retail ball either.
So it's not a slam dunk.
There's never a slam dunk. But when you weigh it all up...
What's the score? How do you rate this?
I'm giving this a bullish score of 9 out of 10.
9 out of 10, that's very high.
Look, the stock is down 20%. That offers you a discount on the undisputed leader in cloud and AI. That painful spending is actually a massive competitive advantage.
A $200 billion wall that no one else can climb?
Exactly. Amazon is digging a moat so deep no one else can cross it.
So what's the time horizon? A quick trade?
No, absolutely not. This is a multi-year hold.
Yeah.
You are buying this for the 2027 AI payoff. You have to be patient.
Don't check the stock price every day.
Please don't. Trust the backlog. Trust that the smartest investors are buying right alongside you.
It's compelling. You know, it brings me to a final thought for everyone listening. We're all so worried about the $200 billion Amazon is spending. The financial press can't stop talking about it, the cash flow, the spending.
Yeah.
It's too much. But I think you have to ask yourself this. If Amazon didn't spend that money, if they decided to save the cash, maybe buy back some stock, and let Microsoft or Google build the future of AI, would you still want to own the stock?
That's the real question. And for a growth investor, I think the answer is a clear no. You own them because they are the builders.
Exactly. Sometimes you have to spend the money to own the future. If they stop spending, they stop growing.
Couldn't have said it better myself.
Thanks for joining us on Smart Wealth with Joshua.
We'll see you in the next market update.